So maybe to give you all the chance to explain your business models, and we can start with you, Erik. It's a scalable capital. Maybe you can explain yourself and your business to the audience.
Yeah. So Scalable Capital is a robo-advisor or digital wealth manager, as it's sometimes called. And we have basically, our business has two pillars. One is a B2C business, where we basically construct and manage ETF portfolios, automated ETF portfolios for private individuals, mainly in the DACH region and in the UK. And we also have a B2B business, where we basically do the same, but as a software as a service company for big banking groups, insurance companies, or corporations. Yeah, some of the partnerships were mentioned. We do this for ING, we do it together with Siemens, with Santander in Spain, and Targo Bank in Germany, and a couple of others will follow.
Tamaz?
So we're doing almost the same, but not quite. So we are a savings marketplace. So our core product is actually savings accounts, term deposits, and overnight deposits. We serve directly the customers in 31 countries across Europe. Out of those, 7 are active platforms. And we have the B2B part as well, where we offer our products through an API through financial service providers like N26, like Commerzbank, BBVA Bank in the Netherlands. And we have a small part where we also offer them good investment products, or a very basic investment account where they can diversified small amount investments into capital markets.
And Jörg, before we dive into your analysis on the fintech developments in Europe, maybe you can give us a short introduction on what you are doing today, because what we know from you is more your part as a state secretary and at the ECB, the European Central Bank. What are you doing today?
Yeah, I'm working for Lazard. That's a global financial advisory firm. We are not really a fintech. We are 153 years old. So it's the opposite. What we have together, that we are all best in class. That's different. So what I currently do, I'm the head of M&A for Europe. I run the financial services business also in Europe. So besides traditional M&A, we do funding rounds for all kinds of companies. We do IPO advisory, and if things go wrong, we also do company restructuring. So it's a broad range, but we are not an investment bank. We are not investing ourselves, so it's advisory only. It's a clean-cut business model that I can explain to my daughters as well.
So, all right, I hope you got it. So before we, you can keep the microphone, Tamaz. Before we dive deep into what is happening, what is going on in funding in fintechs, I would like you, Erik and Tamaz, to explain your business model in Germany. It's quite a specific approach you have, and Germany is a specific country when it comes to private investments. Maybe you can give us an overview on the specific challenge you see there.
So I can start, because we are actually started very much pointed towards the German market. So Germans are great savers when it comes to putting money aside, but not so much when it comes to putting money work for you. So that actually on average more than 10% of net income is going into the savings area. But when you look how it's deployed, that's a bit of a tragic story. So Germans love savings accounts, so bank savings, and there they get currently on average 0.2% in Germany. So it's a quite a low return, far below the inflation. And the first product which we launched for is a marketplace exactly for that challenge, to give them a broad choice of products and providers from all over Europe. So currently we have 77 banks bidding with more than 200 different types of accounts for private savers money, so that they can optimize their yield on their overnight and term deposit accounts. So on average we have generated last year around 1% return for those customers instead of 0.2. So that's quite a bit of an upside in relative terms. And the second product is actually going after the investment need, because if you look to Germany, then not only they are mainly on the savings side, low-yielding savings account, but if they do investments, they do it rather with active accounts and average cost in Germany being 2.4% in the current low yield environment, so quite high. And the other thing is they follow typical traps for private investors, so do not diversify and do market timing. And that is exactly what our other product, Weltinvest, is trying to help them, exactly to avoid that at a very low cost of 0.49%, including product cost. So I think that's a market-leading price point. So that is the challenge is low returns, over-reliance on savings, or very expensive investment products. We try to solve those problems.
Erik?
Yeah, so as I said, our core B2C offering is basically an automated ETF portfolio. So this whole robo-advice idea could also be described as a kind of an ETF concierge. Basically, when I try to explain it in a really simple term, that I want to basically tell potential customers that we or other competitors in the market are actually the simplest and easiest and most convenient form to invest into ETFs. Why? Because ETF, and we've seen this in Vu's presentation, this is really, it's a massive development. It's probably the best innovation the financial industry did in the last 20, 25 years. And you see massive amounts of money going into it. And not just retail money, also institutional money. Yeah? Number one reason is you can get a diversified portfolio for a fraction of the traditional costs. But it's not that easy, actually. It's not that easy to basically construct an ETF portfolio yourself. That's also what Vu touched upon. Banks usually don't help you because they can't pay the investment advisor through ETFs. It's simply not possible. There are no kickbacks or margins. And doing it yourself is possible, but for a lot of people, it's just too inconvenient. Yeah? And we see this with our customers, actually. Our single biggest customer group or customer cohort are computer scientists and bankers. So people that are close to technology and close to numbers. So you might think they could do it themselves, but they just can't be bothered. Yeah? They have a busy life. They want someone else to do it. So and you can use technology to do that for you. And that's basically the core proposition of us or also of other players in the market.
So now we zoom a little bit out. We talked about customers investing on your platform. Now to you, Jörg. When it comes to fundings of fintechs and startups, insurtechs, thank you for your alertness, Tamaz. It must be, we see huge funding rounds, for example, with Raisin, or BlackRock has invested in Scalable. So is it heaven on, what is it? No, heaven on earth at the moment. So everyone gets a lot of money because everything works, or what's your perspective on fintechs and insurtechs in the European market?
One should be honest, it's not paradise for everyone. Yeah, the market, in our view, looking at the last 2 to 3 years all over Europe, is clearly polarizing. And if you are best in class, as these two chaps represent their companies, it's relatively easy to get funding from global VCs, global corporates, global corporate VCs, to relatively good valuations. But if you're on the other end of the spectrum, where the rest of the crowd is sitting, it gets more and more difficult in a situation where very likely we are reaching at least a moderation of growth, if not the end of the cycle. So you can see at the other part of the market, you even could see that companies don't get funding for the C or D round, and then you can sometimes even observe what we call rescue M&A, that someone is just bought for a very small price in order to keep the staff, maybe the brand or whatsoever. So we all know the examples even in Berlin that takes place. Yeah. So the view on the whole fintech space is indeed there will be ongoing consolidation, even more than, let's say, in traditional banking or traditional insurance, because scale is everything. So if you're number 1, 2, maybe 3 in the market, it goes up like this. If you don't manage to get to these positions through organic growth, inorganic growth, it will be more and more difficult. So I see in Germany, but all over Europe, a wave of consolidation, and it's a bit like the winner takes it all. Maybe the 2 or 3 winners, but that's it.
And you talked about seeking rescue M&A. You said, so what's your read on this? Is it a good sign for the market because IP and the people are not lost and they can bring in their expertise to the new now fusion with or merger with another corporate or another fintech?
Yeah, I mean, it's a kind of, to be very frank, it's a face-saving exercise. Yeah, you keep maybe the brand, you keep the staff, but it's a sign, of course, that you have not succeeded in the market to get clients and clients with whom you make money. I mean, if one is very frank, there are 2 things that the old-fashioned incumbents, let's say in banking and insurance, have. These are the 2 C's, that's clients and capital. I mean, with all the respect what these 2 companies have achieved, if you look at the number of clients compared to traditional, old-fashioned, boring incumbents, there's quite something that you can gain. Yeah, so that's the point. Even if you have a good technology, have a good platform, it's a bit like engineering in car production in traditional German manufacturing. Sometimes it was over-engineered, technically perfect, but there was no client who was willing to pay. That is not different in the digital economy. You might have a perfect platform, your software developers are first class. If you don't find clients with whom you make money and are able to scale it, then you will simply need to exit the market.
And you can keep the microphone. Do you see a difference in the US and Chinese market compared to Germany and Europe? And if so, why is there a difference in funding? Because we all observed that the big tickets, for example, in the investment rounds to Raisin or WeFox that we had today, mostly are not coming from domestic investors. So what's your read on that, and why is there a difference in these markets?
I mean, just to oversimplify, the clear difference is in the US and in China, stay with this one Asian country, you have a huge home market, while Europe still is very much fragmented. I mean, the EU 28, soon 27, is very much fragmented. I mean, banking union or capital markets union, banking union is not complete. Capital markets union, I still miss to get what really the content is, even looking at it very carefully. So we have a fragmented European market, and you can see this. If you look at funding rounds, we have made a study at Lazard for the last 5 years. Funding rounds where the volume is up to 20 million are predominantly done by domestic finance. Yeah, the top 5 countries where then the funding comes from are the UK, France, Germany, Sweden, and Italy. So this is really domestic. If you have funding rounds that go above 20 million, so for really Series B, C, D, you have an absolute predominance of US venture capital funds and US corporate venture funds. And the second position is taken by Chinese VCs of all types and Chinese private equity. They are private equity firms with a bit of a different angle, yeah. And so there is, for larger financing rounds, a clear predominance of US and Chinese capital. And I fear it will stay for the foreseeable future like this, because the market fragmentation and the lack of certain, let's say, institutions that collect capital, like large pension funds, we simply don't have in a number of European countries. And you can see when you look then who is investing from the European side. Yes, of course, you have venture capital funds, but on the second place in the overall aggregated statistics, you find governments. This is the try of a number of governments, like in Germany with KfW, to replace the non-existing funding ecosystem by government investment.
So I got a sign that we should all move a little bit into the light. Thank you very much for that. Sehr smooth. There are differences, as we heard. Do you feel this is a disadvantage for you, Tamaz and Erik, that there is not so much capital available in Europe, or is it easy to attract the money from outside Europe for to invest in your companies?
I mean, that's what Jörg mentioned. The money is available. It's just not German money. Yeah, it's even German VC money is most of the time not German money, but US, Asian LPs into German VCs and then into German startups. So the money is available, and it's also, I mean, one angle is also when you talk to European or specifically German VCs, they close in their fundraising, they close their funds at a certain level. So we always, like in the press, and I was last week I had a meeting with some governmental officials. There was a big talk, we need these bigger pools of capital. That's when the startups will come. I think it's completely the other way around. Yeah, you need basically you need a true single market, a huge homogeneous home market. Then you can build startups that can absorb the money. Yeah? Most of the German VCs, they close their funds at 200, 250, maximum 300 million. They can't even have 500 million or billion funds because they can't write enough 50, 100, 200 or 500 million tickets. It's just not, there are hardly any companies. Some companies there are, but hardly any companies. You see this in the US and Asia much more. And also it's much cooler to get US capital, I think.
Yeah? Is it?
I mean, yeah.
All right.
When you... making a bit of a joke, yeah, but when you get BlackRock money and then you go to one of these fintech events and you get the high fives and you go to travel to New York for the closing dinner, it's much cooler than going to Bielefeld for a corporate venture investment.
So that's the reason, remember. All right. So Tamaz, you are also in the board of the working group on fintechs at Bitkom, so we work closely together. What's your perception? Does the politicians in Germany realize, in the European market, realize this problem?
Yeah, I think it's too easy to say it's all the startups themselves. I would say there is something politicians can do, and this is really crucial. One thing is share ownership, how you handle share ownership and initial investments. And I mean, we have anecdotal evidence. We have a high-ranked French employee in our company who is almost impossible to grant him an ESOP scheme, which doesn't penalize him and penalize us, to a level where actually 100% of the ESOP value is paid out to the state, to the French state. When you look at the initial investments, we have schemes in Germany which are coming up, which are purely application-based. There is no single scheme where you would just invest into a startup and would be tax-free. So initial investments are penalized, and share ownership is penalized. That puts startups in a position where they either have to pay high salaries, or how do you attract good talent from China, from the US? The second thing is, I mean, pension funds industry, which is the major source of the money, is mainly in the US and Canada. We still do not have any meaningful private pension scheme in Germany, and that's a fundamental issue, because where the money is also where the money is invested to, because that is then ecosystem and a network which helps you. The last thing is, I think, since probably your period or even before your time, financial industry is very unpopular, so that actually if you ask German politicians would they like to attract funds into Germany, this is the last item on the agenda, or even out of the agenda, so that who is going for this? It's Luxembourg, Ireland, but definitely not Germany or other large countries, so that there is also no ecosystem or no political help or legal help to create an industry here. So I would say it's not only all the stupid startups which are not scaling fast enough, or the market, but it's also politics which can help a lot.
Erik, you mentioned the high five effect of BlackRock, and it's extremely cool to have an US American investor, but also BlackRock is a strategic investor, so maybe you can give us a little bit of insight of having a strategic investor on your cap table.
Yeah, so we went through in the beginning through the classic phases. Yeah, the first phase, angel investments, and then 2 German venture capital funds, Holzbring Ventures and Tengelmann Ventures came in. And then quickly we were approached by BlackRock. And I was oversimplifying it a bit with the coolness factor. We actually thought long and hard whether we should do it or not. Yeah? Because taking a strategic investor early on, that also gets a substantial stake. Yeah? If it's just about 5%, you can just do it. Yeah? But if he gets a substantial stake, yeah, also with the view of acquiring more, maybe even controlling stake in the future, you have to think very carefully and very hard. Yeah? And I think if it's constructed in the right way, it can really, really be great. And so far, that has been with us the case. Yeah? If it's not constructed in the right way, it can close exit options and be a complete disaster and slow you down. Yeah? Why we decided for BlackRock and they decided for us is mainly what BlackRock wants is, so they are the biggest wealth manager, but they want an increasing part of their revenues to come from technology in the future. They already have a super big technology business. Yeah? Most people just know them from ETFs and funds, but the Aladdin business. Yeah? But it's a B2B business. And now they're pushing hard into other technology segments of the market. And also it's when you talk about most of the big financial players, yeah, the big banks, the big insurance companies, they're usually 100, 150 plus years old. BlackRock is not an old company. Yeah? It's 30 years, it's a couple of years older than Amazon, and they still have that founder-led, Larry is still the founder and the CEO, this founder-led culture, and that's eventually what convinced us to partner with them. And so far it has worked out very well. A lot of the deals that we've won, that I've mentioned, the Santander deal in Spain, we would have never won without them. So there it really helps. But if you're a founder and you're thinking about getting strategic capital on board, think really hard, can they actually help me in my business? Yeah? Can they help me close deals? Can they do something else for me? If the answer is no, then think twice about it. It's not just about the money.
And Tamaz, you have PayPal, for example, on your cap table. So is this a strategic investor, or is it just like diversifying their investments?
Yeah. So we are on the other end, so it's like around 5% or slightly below that. So it's not a strategic investor for us. Also on their side, I think it's mainly financial investment. We're talking about different ways to partner, but what I realized after the investment, actually, PayPal is a large company. So they're not in a startup phase anymore, means that the organization which you are talking to has completely different interests. There is a venture arm, there is the business part, there is the business part in Germany, there is the US platform, so there are differing parts, and the animal is just large. So in that sense, I would say that if you are a founder, then the only guy who defines your future are yourself. It's not a strategic investor, someone, the god, or someone who helps you build the client franchise. So that's yourself, and if you're successful, then you are an attractive partner for others. And if you are not, then you are not. So the investment will not help in that.
Jörg, what's your read on this having a strategic investor from your M&A advisory perspective? Is it harder to get money after a strategic investor has bought a stake in?
The correct answer is, as often, it depends. I mean, it's a permanent and very fundamental debate if we advise on a financing round, VC money versus strategic money. Yeah, there are clear pros. Erik has alluded to them. If you have a good strategic investor, it can open doors that you never could open yourself. That's the obvious pro you have. There is a con, that's the question Tamaz alluded to. Are you still independent? Are you still a founder running a company, or are you just a distribution fancy channel for a global corporate? To over-sharpen now the argument. So I would look at it in each individual situation very carefully, really spend time on it, thinking about, are the pros larger in scaling up my business than losing a bit independence in decision making? And of course, looking forward. It can be the case that in Series B you take a strategic investor which then locks you in for the next funding rounds. Yeah. Sometimes you don't have the choice. I mean, if you're short to running out of money, you take in the cap table what you get, but then you see a year later that was maybe not a perfect choice given the optionality you wanted to have later. So that is always a good point. If you take in one strategic investors, others might stay away or are even forced to stay away from the first investor. What we increasingly see but only in the US currently are so-called club deals of investors, that you have a group of 4, 5, 6 strategic investors that join one, let's say, startup firm at the same time, all take whatever 5%, together they get 30, often minority stakes at the end. And this is an interesting trend because it shows that in a certain subsegment of a market, the new entrant is on the way to establishing a kind of market standard. And this, of course, drives the valuation like hell. If you are seen by the market standard, so let's say if 5, 6, 7 banks invest into one infrastructure provider, it's relatively clear without any public acknowledgement, this could be the future informal industry standard. But we haven't seen this in Europe yet. I know one is prepared, but let's see.
Yeah, like these guys, yeah. I mean, some of them IPO'd, but these are historically conglomerates of banks forming the payment system, then later spinning it off. I mean, huge successes.
Yeah.
Hundreds of billion in market capitalization, bigger than any bank you can see.
Unfortunately, we talked a little bit about running out of money. Problem is, we on stage have the problem of running out of time. But can I promise our audience that you will be approachable out there to raise some questions to you? Okay, you heard that. So thank you very much, all of you. Thanks, bye.